Hey guys, Rahul Shah here, trying to make investing accessible and profitable for the average investor. It's raining IPOs. Over the past few months, there has been barely a single day where there isn't some or the other IPO going on. And why not? The markets have not been this buoyant for quite some time now. The sentiment is extremely positive, and promoters of course see this as a very good opportunity to come out with IPOs and earn big subscriptions and earn good money in the process. Now one such IPO, or one of the biggest IPOs to have hit the market in recent times, is that of Kalyan Jewellers. Of course the IPO opened yesterday and it will close for subscription tomorrow. But it's a big company, and I'm sure you must have heard the company's name courtesy the booming baritone of Mr. Amitabh Bachchan. If I'm not mistaken, Mr. Bachchan is the brand ambassador for the company, and he's been coming on various media outlets, on television, on YouTube, in print media, and recommending you to buy the company's jewelry and the company's products. Having said that, is the company worth a long-term bet at the price at which the IPO is coming out? Is the company a good long-term investment? And should one go ahead and subscribe to this issue? So let's just try and find that out. Just try and do some basic analysis of the company and see whether it's worth subscribing to the IPO or not. Now, as far as IPOs are concerned, I think there are two kinds of investors. One who's investing in the company just for listing gains. They subscribe to the IPO in the hope that the stock will have a big bang opening in the stock market, a big bang listing, and they try and exit at the first sign of huge gains. And then there's other kind of investors who think of investing in the IPO from a long-term perspective. They take a long-term approach, long-term view, and then decide whether they should invest in the IPO or not. If you are the first kind of investor, no harm in doing that, but that is not an investment. That activity falls under the category of speculation in my view. And no harm in doing speculation as long as you know that what you're doing is speculation, and you are being cautious with it. You're not overdoing it. I believe that if you have 100 rupees to invest in the stock market, you can speculate with 5 or 10 rupees, but not more. So therefore, if you are trying to subscribe to the IPO in the hope of getting a listing gain, go ahead and do it, but do it with your eyes and mind open, and don't bet the farm on that. For the other kind of investor who's looking to invest in a company from a long-term perspective, it is important that he tries to understand what is the fair value of the company and whether the IPO price is at a significant discount to the fair value of the company. So let us just try and understand the fair value of the company from whatever little information we get from the company's prospectus. Now, in order to arrive at the fair value of the company, I need two things. From the financial history of the company, I need to know the company's earnings power, the earnings potential of the company, and the expected growth in that earning power over the next, say, 3-5 years. And I also need to know the quality of the earnings in terms of the capital efficiency of the company, how good the company is at generating good returns on equity or good returns on capital. Now, as far as the prospectus of the company is concerned, there is very little historical information. I think the historical information is available for the past 3 financial years only. Ideally, taking a look at a 10-year history of the company is a good way of trying to understand trying to arrive at the fair value of the company. But here in this case, we have only 3 years worth of financial data, so it may not be that reliable. Ideally, we would like to see the earnings record of the company going back 10 years. So there are some limitations there. Having said that, the 3-year information of the company, or the 3-year track record of the company, is not pretty impressive if you ask me. The EPS of the company, or the earning power of the company, is in the region of 1.5, 1.6 rupees per share. it has not managed to grow its earnings. In fact, I think in the second of those 3 years, or in the middle of the 3 years, it has also incurred a small loss because of the whole, I think, pandemic situation that we are facing. Because of that, the company has incurred a loss. But the average earning power of the company, or the earning power of the company for these 3 years, has been in the region of 1.5 to 1.6 rupees per share. The return on equity, the capital efficiency of the company is in the region of 6 to 7% for each of these years. Of course, the first and the third year, because the second year was loss making, so we'll not consider that for the time being. So for the first and third years, the ROE of the company is in the region of 7 to 8%. This is poor in my view, because for an average Indian corporate, if you were to invest in a decent company at decent valuations, the average ROE has to be in the region of 12 to 15% at least, if not more. Since the company is earning half of that, it is a poor performance in my view. Now, given the historical growth of the company, the earnings power of the company, and the quality of those earnings, or the capital efficiency of those earnings, what is the price to earnings multiple that you should give to a company like Kalyan Jewellers? My own experience in the stock market and the experience of the other gurus that I follow and I look up to, according to them, for a company which is earning an ROE of 6, 7%, 8%, and which is not growing that fast, if you look at the growth rate of the company, should not be more than 12 to 13 times. That's the maximum you should give to a company of this kind, which is low ROE, and even though we have very limited data on the company, but the earnings in those 2-3 years have not grown that much. So low growth company, and the price to earnings multiple should not be more than 12 to 13 times. Now the company has a price band of 86 to 87 rupees per share. That's the price at which I think most of the retail investors would get the company shares at, and there could be some discount for retail investors, say 5-10%. So price of around 80-85 rupees and the earnings of 1.6 rupees gives you a price to earnings multiple of 55 to 56 times. For a company that, according to me, whatever little experience I have in the stock market, which generates low ROEs and it hasn't grown that much, it should get a price to earnings multiple of not more than 12 to 13 times, and the company is listing at a price to earnings multiple of 50-55 times. Now what this means is that suppose you have to earn 15% returns per annum in the company. If you invested rupees 80-85, 3 years from now the company should trade at a price of not more than 130-135 rupees, and if you apply the price to earnings multiple of 12 to 13 times, the EPS of the company the next 3 years should be in the region of around 9 to 10 rupees. Right now it's earning an EPS of 1.6 times. 3 years from now it should have an EPS of 10 rupees at least for you to make a 15% CAGR on the company at a price of rupees 85 per share. For this to happen, the company will have to grow its earnings at a CAGR of 70-75% per year over the next 3 years. Now this is a very difficult thing to do in my view. Not many companies can grow at a consistent rate of 70-75% over the next 3 years, given especially a company like Kalyan Jewellers, where the growth historically has not been that great. Therefore, the risk reward ratio of investing in the company is on the higher side in my view. If you have to make even a 15% CAGR on the company over the next 3 years, its earnings will have to grow by 70-75%, given that the company should deserve a price to earnings multiple of not more than 12 to 13 times. So the risk reward ratio of investing in the IPO, I think, is definitely on the higher side. Investors should consider this when subscribing to the IPO. Now what happens is, you have a 400-page prospectus of the company, and a lot of investors, they end up doing a lot of detailed analysis of the company. They'll read the entire prospectus of the company. But I don't think this approach makes a lot of sense. The first thing that you should do is have a broad back of the envelope calculation on whether investing in the company even makes sense from a 2 to 3 year perspective. And if you are convinced by doing this back of the envelope calculation that there is a need to do a deep dive into the company, the valuations upfront look very attractive, and therefore one should study the company in more detail, only then you should try and do a detailed qualitative analysis of the company. But like in the case of Kalyan Jewellers, where the company is coming out with a very high price to earnings multiple, and which will require a lot of growth over the next 3 years for us to make even decent returns on the company, then I think if your back of the envelope calculation suggests that this is not possible, it's not possible for the company to grow its earnings at 70-75% for 3 years, then you should not do a detailed analysis of the company, and you should maybe take a back step and say that the risk to reward of investing in the company at the current valuations, or the valuations at which the IPO is coming out, is not in the favor of the investor, and therefore it's a very high risk bet. And therefore I think one should maybe not invest in the company, or take a speculative approach where you're investing based on listing gains, and you're not putting a lot of money into the IPO. So your approach of what you should do with the IPO should be based on this, I guess, this simple analysis. So that was our view on Kalyan Jewellers, the IPO of the company. Do let us know what you think of it, and we would await your comments as usual. Take care. Thank you so much. I'll see you again next time. Bye.